Good morning. Welcome to Kenya News Update today. I'm your host, and we're diving deep into a story that's shaking up the global tech landscape and has major implications for the future of artificial intelligence. Oracle, the legendary database giant, saw its stock surge a staggering 9% in after-hours trading yesterday. This dramatic spike came on the back of a surprisingly strong fiscal third-quarter earnings report. But this isn't just a story about a single company's financials. This is a story about a high-stakes, multi-billion-dollar race. It's a story about whether an old-guard tech titan can reinvent itself for the AI era, and it's a story that directly answers mounting concerns on Wall Street about the astronomical costs of building out AI infrastructure. We'll break down the numbers, analyze the strategy, and explore what this means for the global competition in cloud computing. Strap in, this is a 12-minute deep dive. Let's start with the headline numbers that sent shockwaves through the market. For the quarter ending February 28, 2026, Oracle reported total revenue of $13.8 billion. That's a solid increase, but the real story is in the breakdown. Cloud services and license support revenue, the company's largest and most crucial segment, came in at $9.96 billion. More critically, the remaining performance obligation, or RPO, which is a key indicator of future revenue, soared to a record $80 billion. That's an increase of 29% year over year. Now, let's put that in perspective with a key visual. The company's total cloud revenue, which includes both infrastructure and software, hit $5.1 billion for the quarter. That represents a growth rate of 25% year over year. But the infrastructure component alone, the part that directly competes with Amazon's AWS, Microsoft Azure, and Google Cloud, grew by an eye-watering 49%. This is the engine of Oracle's future, and it's firing on all cylinders. So why was Wall Street so concerned before this report? The answer lies in one phrase: capital intensity. Building the data centers, servers, and networking gear required to power generative AI models like those from OpenAI or Google's Gemini is phenomenally expensive. We're talking about investments measured in the tens of billions of dollars. Just last quarter, Oracle's capital expenditures jumped to $2.5 billion, a significant increase from the previous year. Analysts were worried that this spending spree would crush profit margins and eat into earnings for years to come. The fear was that Oracle, in its quest to catch up to the cloud leaders, would hemorrhage cash. CEO Clayton Magowiak directly addressed these concerns on the earnings call. He made a bold statement that we need to highlight. He said, and I quote, "We will not issue any more bonds in 2026 beyond what was already announced." This is a massive reassurance to investors. It signals that the company believes its current cash flow and existing financing are sufficient to fund this aggressive build-out. Let's visualize that commitment. But how is Oracle attempting to differentiate itself in this crowded and costly field? Their strategy hinges on two key pillars. First, a unique technical architecture. Second, a focus on a specific, high-value customer segment. On the architecture front, Magowiak touted what he calls a bring-your-own-hardware model for AI training. The idea is that customers with existing investments in NVIDIA's powerful and scarce GPUs can plug them directly into Oracle's cloud. This reduces complexity and potentially cost for those clients. It's a clever way to attract businesses that have already secured these critical chips but lack the scale to build their own superclusters. The second pillar is a relentless focus on sovereign nations and regulated industries like healthcare and financial services. Oracle is betting that its decades of experience handling the world's most sensitive data for governments and banks gives it a unique edge in the age of AI, where data sovereignty and compliance are paramount. Now, let's look at the financial health and scale of this endeavor. Oracle has committed to spending $50 billion over the coming years to expand its data center footprint globally. To put that in perspective, that's more than the entire annual GDP of a country like Kenya. It's an almost unimaginable sum dedicated to concrete, steel, and silicon. The company's total debt currently stands at approximately $90 billion. However, they have a cash reserve of about $29 billion. Their operating cash flow over the last 12 months was a robust $19 billion. This financial firepower is what allows them to make these bets. But the market wants to see returns. The quarterly earnings per share came in at $1.41, beating analyst estimates of $1.38. More importantly, operating margin expanded slightly to 44%, showing that the company is managing its growth spending without completely sacrificing profitability. Let's visualize the scale of their investment versus their cash position. However, no analysis is complete without considering the competition. Oracle is not operating in a vacuum. The cloud infrastructure market is dominated by what we call the hyperscalers. Amazon Web Services, or AWS, is the clear leader with over 30% market share and quarterly revenue north of $25 billion. Microsoft Azure is a fierce second, heavily leveraged through its partnership with OpenAI. Google Cloud Platform is third but growing rapidly, fueled by its own AI models like Gemini. These companies have deeper pockets, larger existing customer bases, and started their cloud journeys over a decade before Oracle took it seriously. For Oracle to succeed, it must execute flawlessly on its niche strategy. It must convince governments and large enterprises that its cloud is not just competitive, but superior for their specific, sensitive workloads. One analyst on the call pointed out that while Oracle's infrastructure growth is impressive at 49%, it's starting from a much smaller base. AWS's infrastructure revenue is still more than 5 times larger. Let's bring in a critical perspective. We spoke to several financial analysts to get their take on this earnings surprise. Sarah Chen, a senior tech analyst at Bernstein, offered this insight. She said, "The 9% pop is a relief rally, plain and simple. The market was braced for a margin disaster that didn't materialize. The no new bonds pledge is the headline. But the long-term question remains, can Oracle sustain 50% infrastructure growth when the law of large numbers inevitably kicks in? Their sovereign cloud focus is smart, but it's a marathon, not a sprint." On the other hand, Michael Rodriguez from Wedbush was more bullish. He stated, "This report proves the doubters wrong. Oracle's database dominance is translating into cloud contract wins. The RPO of $80 billion is a tidal wave of future revenue. They are becoming the Switzerland of AI cloud, neutral, secure, and trusted by nations. That's a moat the hyperscalers can't easily cross." This debate is at the heart of Oracle's valuation. Speaking of valuation, let's look at the stock's performance. Even with yesterday's 9% surge, Oracle shares are still down about 15% for the year to date, 2026. This year has been brutal for many tech stocks as interest rate concerns have resurfaced. The stock trades at a forward price to earnings ratio of about 21, which is roughly in line with the broader software sector, but at a discount to faster growing cloud pure plays. The dividend yield is a modest 1.4%. The market capitalization now sits just above $320 billion. To understand the investor sentiment shift, we need to look at key ownership metrics. Institutional ownership remains high at over 60%. Insider selling has been minimal over the past quarter, suggesting executives are confident. Short interest, which is a bet that the stock will fall, had crept up to around 2.5% of the float before the earnings report. We can expect a significant portion of those short sellers to be covering their positions after the surge, which could provide further upward pressure on the stock in the near term. What does this mean for the broader AI and cloud ecosystem? Oracle's relative success is a validation of the overall market demand. It shows that there is room for more than just 3 players. The global AI infrastructure build-out is not a winner-take-all market. It's a multi-trillion-dollar opportunity with space for specialists. Oracle's focus on sovereign AI, where countries want their data and AI models to reside within their own borders, is a growing trend. From the European Union to Southeast Asia, governments are enacting strict data localization laws. Oracle, with its legacy of serving governments, is well positioned. Furthermore, its strategy reduces the risk of customer lock-in that some fear with the dominant hyperscalers. If you can bring your own hardware, you have more flexibility to move, which is appealing to large, sophisticated buyers. Let's project forward. Based on the current trajectory and the massive $80 billion backlog, what can we expect? Analysts are now revising their models upward. The consensus revenue estimate for the full fiscal year 2026, ending May 31st, has moved to around $56 billion. For fiscal 2027, estimates are clustering near $63 billion. The key metric to watch going forward will be the capital expenditure line. If Oracle can continue its rapid cloud growth while keeping CapEx disciplined, the stock could rate higher. The next major catalyst will be the announcement of new data center regions, particularly in emerging markets in Africa and Asia, where data sovereignty demands are rising. Another will be any major sovereign nation contract wins, which Oracle tends to announce with great fanfare. In conclusion, Oracle's third quarter earnings were a masterclass in managing Wall Street expectations. They delivered strong growth where it mattered most, in cloud infrastructure, while simultaneously calming fears about a financial cliff. The 9% stock spike is a reward for that communication and execution. However, the challenges are immense. They are competing against some of the most powerful and entrenched companies in history. Their strategy is high risk, high reward, betting that trust and security will trump raw scale and a broader ecosystem in the age of sovereign AI for investors. It's a compelling turnaround story with a clear narrative. For the tech world, it's a sign that the AI infrastructure race is just heating up, and there will be multiple lanes to victory. The oracle of old is speaking a new language, the language of AI, cloud, and global infrastructure. And for this quarter at least, Wall Street is listening. This has been a Kenya News Update Today deep dive. Subscribe to Kenya News Update Today for more incisive analysis of the stories shaping our world.